Hi everyone, this is Adam Feinberg, and I get so many requests asking for updates on the real estate market in Manhattan. And so many of the questions I get, they are almost identical, from coming from so many different sources. And I felt, maybe, putting out a video out there right now might be the better path for me to answer a lot of the same questions. And then, from there, if we've got one-on-one questions, I'm always happy to address. But this might be a better way for us to cover so many of these things. And, everyone's like, how's the market doing? What's the market doing today? Is it up? Is it down? What do I need to know? How are mortgage rates? How is this neighborhood? How is this product type? So I think this is a kind of a better path for us to explore and to take in. So today I want to talk about the bigger picture in terms of economics, from a national housing standpoint, and then drill down into Manhattan and the specifics of our neighborhoods here, and then drill down further into my area of expertise, which is going to be Upper Manhattan, basically north of, let's say, 96th Street roughly, and and how that market is different than the rest of Manhattan. So first off, let's just talk about it. And I'm going to go at this kind of free will and whatnot. I've taken down a few bullet points of things that I want to cover, but not necessarily I don't have a scripted routine here. So, my answer might vary slightly, if you ask me a different question, but overall, this should be consistent with my overall larger message. So everyone is always asking, well, take my 16 plus years of experience in capital markets, and how do we translate that into a real estate purchase or sale here in Manhattan? So first off, let's talk about the big picture, the larger economic scheme in terms of the entire nation. And, right now, there's a lot of talk and a lot of fear and a lot of concern about what's going on in the political world and how that winds up translating into our economic scheme. And, from that aspect, I don't want to dive too deeply into the political, but I will talk about how some of the political aspects are making its way into the economic and financial community. And I think that's the best way for us to approach it, because, there's going to be people on every different side on this. My idea is never to kind of ostracize anyone, but just make sure that we're covering things in a way that, I relay from my capital markets world experience. So from the bigger picture, a lot of things that wind up impacting your typical buyer in this market, it's going to be interest rates. And, everyone's worried, what is the economy going to do? Are we going to go into a recession? Is the market going to crash? First things first, let's just talk about the impact of interest rates and see, and I think the most important aspect is watching right now. And, just as a full disclosure, they were my former employer many, many years back. It's almost right around 15 years or so since I worked for CME Group. But, if you're not sure what I'm, referring to, I'm looking at the CME Group's FedWatch. So if anybody's interested in learning more about what traders are predicting going forward, for interest rates, all you have to do is Google CME Group FedWatch, and that stands for Chicago Mercantile Exchange, and they just shortened it to CME Group. So if you look at FedWatch, and I've got it up on my screen over here, and what I'm seeing over here is that traders as a whole, that next Federal Reserve meeting is June 18th, and today is June 1st. So not that far ahead, but still almost 3 weeks away. And traders, for the most part, nearly 95% of traders are expecting interest rates to remain steady from where they are today, which is currently 425 to 450 basis points. And, for those that aren't familiar with these short-term interest rate, terminologies and what they represent, first off, 100 basis points equals 1%. So when I say 425 basis points to 450 basis points, that equals 4.25% to 4.5%. And that's relevant because that kind of sets the tone for, as you go out into longer dated, lending operations. And, this is an overnight rate and it's short term as short term gets. And that winds up ultimately tying into the 10-year treasury, and the 10-year treasury relates to our 30-year mortgage rates. So that's the reason why this is all so important. It all ties in together. And right now, the vast majority of traders are expecting that overnight rate to stay the same. As we look forward going through the year, traders overall, and, I don't even know if it's fair to project this far out right now, but if I look to the end of the year, the last Fed meeting, which is December 10th, the last Fed meeting of the year, traders are expecting interest rates to drop no more than a total of 75 basis points. Now, that is not necessarily always going to account for everything that's going on in the market. And these things I kind of expect are going to shift to some degree or another. Nobody has got a crystal ball. Nobody knows exactly what's going to happen, but there are things that we're going to discuss in this video that really try and address at least some of the uncertainty and the concerns that are in the market. So, I talked about interest rate. I talked about, how the Fed, they might cut, up to as many as 3 more times, 25 basis points each move. Maybe it's 2 times. Maybe one of those is 50 basis points and one is 25. Nobody has got a crystal ball. Nobody knows for sure. But I think these are the likely scenarios. So that said, I'm looking at also the St. Louis Federal Reserve. They published this database called FRED, and they've got a median home price index, and they chart it out for you. Now, if you go back from the 1960s to today, their charts track home prices, the median home prices, from going back as far as 1965. And what you'll see is on these charts, without necessarily going into all the technical aspects and whatnot, but home prices typically came close to tracking with inflation and with that note. So you tended to see this kind of stable but slightly upward line, year after year, where home prices would go up maybe 2-3%. And then you get a few blips, especially as you look in, for instance, the Great Recession, 2006 to 2009, 10, and you see a little bit of a blip in terms of, how the median home prices, end up going, first up and then way down. But generally speaking, from 1965, onward, up until COVID, that home prices have been fairly stable, fairly predictable, and they tend to go up over time. So when a lot of these other real estate agents start giving you economic talks, especially those that they're listening to an economist within their firm, but they don't necessarily know the information themselves. They don't have this finance economics background that I have. So a lot of them are just kind of giving you the scripted information. But what I can tell you is typically when they say that home prices don't necessarily, go down during a recession, they're not lying to you. They're not giving you any misinformation, but they're not necessarily giving you the full story as it relates to, I think, what we're looking for going forward. So when I'm looking at the data, all of a sudden you see the home prices, which are going the steady, nice little upward trajectory, 2-3% a year. And instead, since COVID, nationally, now this is not New York City, this is not New York City suburbs. I don't know all the specifics of New York City suburbs, but I can tell you, that's been a hot market while New York City has been a cold market. And we'll get into the reasons why, but I want you to at least explain the underpinnings. Since COVID, instead of seeing a line that was like this slight upward move, you see more of a slope, more like this, going upward in terms of prices, and prices have skyrocketed since COVID nationally. which kind of, I think, helps explain why I think that, home prices nationally are due to come down. Now, you're going to still have your agents that insist, buy now, price or be priced out forever, all the while prices are declining. And, always every agent is always scared of, suggesting, but they're still going to stick with it because we're all commission based. And, they're going to kind of stick with that even when the knife is kind of like trying to catch that falling knife analysis. Nobody knows where the bottom is going to be. But that said, when I look at that chart and I smooth out that chart, considering annual inflation of 2 to 3% a year, my expectation is that home prices nationally, that median price nationally, should probably be about $100,000 below where it is at today. And that's just by taking a straight edge ruler against that chart and saying, what, I expect that chart to, remain a constant. It didn't. And, now there's going to be a return to normalcy. So, do I think that we're going to have this crash in home prices nationally? No, I don't think that is the more likely scenario, but I think more like this longer term, gentle downward, pricing mechanism. We could have, a little bit more of a shakeup than that, but, or it's even possible in some areas that, prices could go up. Remember, all real estate is local. So, neighborhoods, let's say like that neighborhood in Los Angeles, that portion of Los Angeles that had those torrential, first the fires and then, torrential downpours on top of that. Those neighborhoods are not going to track with the national averages or median income or median anything, because the reality is they're outliers because of these tragic, distortions that are going to impact their market. So things are going to hit differently, in different markets. But nationally, I do expect home prices to continue to drop, or at a bare minimum, kind of hold steady for a while. The reality is, while prices on everything else are going up, I think in the best case scenario, home prices might remain steady in a lot of neighborhoods, throughout the nation, but more likely to drop. So, maybe help even that off. So let's say this is a lost period for X number of years, in home prices in many parts of the country, rather than dropping drastically. So while everything else is going up. So from that case, it might be a very good time to buy in many parts of the country. It's also worth noting that, Manhattan has moved contrarian to the rest of the markets nationwide. So as home prices went up since COVID in most of the nation, home prices declined in Manhattan. There's a lot of reasons for the decline, and I'll get into that deeper, as we move forward throughout this talk. We talked about national prices. We talked about the impact of interest rates. Now let's talk about, and I don't want to necessarily get too deep into the politics. I want to talk about the economic impacts of, Trump's plans. So, with the combination of his tariffs and his tax plan, the combination of the two, what he's publicly stated is, in essence, and it doesn't take a genius to extract this out of what he's trying to say, is basically what he wants to do, and he will never call it this. But what he wants to do, he wants to kind of change the way that we wind up retaining income for this nation. So right now, a lot of our income is really based on the income taxes, or taxes from corporations and things of that nature. Now, he wants to lessen the impact of that through these tariffs and have a different revenue stream coming in as a result of that, which is, in essence, what they do in Europe. They've got these value-added taxes. You will never hear Trump call it a value-added tax, but in essence, that's what he is attempting to do. And his tax plan kind of shifts some of the responsibility, of some of this income, with the hopes of getting these income streams. Now, yes, I know there's a lot of opposition to this. I don't necessarily like this plan, but this is the reality of what he's attempting to do. Now, we don't know how the courts are going to ultimately rule on this, because we know earlier, this past week, that the courts, ruled that it was unconstitutional. And then another court said, well, hold on, let's keep it in place, while we consider the wider court case. So this is something that is an unknown in the markets. Markets don't like unknowns. So this naturally, whether once it's going into effect, whether it doesn't go into effect, is going to naturally impact the uncertainty of our stock markets, our bond markets, our real estate markets, our gold markets, our everything. It winds up impacting everything. So, these are, some important impacts that we just don't know about. I would say, as a generalization, even though this is Trump's plan, I think it's going to wind up hitting us too hard, too fast. And, when combined with things like, some of his other actions, like cuts to, a lot of our government things, I'm like, this is all done all at once, and it's like too much at once trying to do. And I think when you factor in all these things that we haven't even really discussed, that are not necessarily direct economic, but wind up eventually contributing toward that, such as, impacts to nonprofits, research and development, things like safety issues like air traffic, water quality, vaccines, all these types of things, I think will all have an ultimately longer term negative impact on our economy, and will ultimately wind up shrinking our economy. I think there's ways that we could still do these things, but I don't know that, that Trump is interested in pursuing them. These are longer term actions, and Trump likes action now. So that's as far deep as I want to get into the politics aspect of this. But just know that these do not necessarily have a straightforward positive economic impact. Now, let's just say that we can withstand the shorter to midterm impacts of it. Is it possible that Trump's plans could work? Yeah, it is possible. But I don't think we're going to be able to make it over the immediacy and the severity of, what he's doing. I think this is going to challenge some of the other markets, and I think we're going to see some other impacts. So, in terms of those other impacts that we're seeing, and how are other markets absorbing all this information? Well, gold has been hitting all-time highs, I think right around now it's somewhere around 3,300 an ounce, and you see this massive, again, much like the housing market we've seen since COVID, you've seen this huge upward trajectory spike. Markets don't do that. When they do, they typically see a sharp downturn too. Now, housing is a little different than stock markets, bond markets, price of gold, oil. But oil is also been showing signs of that uncertainty as well. So oil has been trading roughly up plus and minus, a little bit, but around $60 a barrel. And that's down quite a bit, from the pre-Trump term. So, it's just indicating a lot more of that uncertainty in that marketplace and concerns of a potential recession. So, right now it's still high enough where, we still got an economy that's chugging along, but, should a downturn, you can expect the price of oil to drop down much further than where it is at $60 a barrel. And I'm talking about West Texas Intermediate crude for those of you that are geeks like me that follow this kind of level detail. But yeah, that's the immediate term contract of West Texas Intermediate crude. And then you'll see it across other commodities as well, and the uncertainty of it, and whether we can withstand the shocks of what we're going through. Now, in terms of those shocks, I think it's important to get to our next point, is that if we look historically, when stock markets, tend to panic, it tends to be in that September-October period. And I think this is at a crucial point, for timing with the political realm too, because you've now given the Trump administration a number of months for a lot of these actions to have taken place and for some of the impacts to start being felt. Now, the stock market tends to operate looking 6 months forward, but I think 6 months from September and October, you're going to look at a bleaker picture if Trump is able to actually enact all the things that he wants to. Now, we don't know what the impacts will truly be and what impacts the courts might actually have. So, a lot of that, could lead to the potential. I don't want to scare anybody, but there is at least setting the tone for a very strong down market, possibly a crash. I don't think that is the likely scenario, but I do think that is a possibility. And I think, if any time in the near future, I think that would be it. So probably September and October period. That said, let's talk about a little bit more about the stock market. Again, I don't want to go too deep. This is really more about real estate. So we'll spend about 20 something minutes, on this, and then we'll spend the rest of our time talking about, the Manhattan market. But, just really quickly, the stock market, I think, over years, the reason why crashes happen is because the stock market tends to be overly optimistic, so they'll see a hint of good news and they'll react to it, and all of a sudden you'll see this sharp upward turn, but it's not looking too deeply enough into the market. So what we're seeing, especially in the advent of automated trading, where there's no necessarily human at a lot of the controls anymore, it's all going based off of either AI models or other kind of predictive trading. And, a lot of these algorithms tend to automatically execute these trades based on what they think of, the news. And, it's doing that kind of analysis based off of that. So I think as a result, there is this bias toward the positive news, and you'll see the stock market more likely go up on something that is only half-formed ideas. So, that's my concern about the stock market. And I think that has historically been the case, but I think it's more exaggerated today with all the automated trading systems out there. In terms of the bonds, and we had a problem with the last bond auction last week, where there weren't enough participants, involved in it. And, to understand the bond market, a lot of people aren't necessarily thinking about it as much. They're usually focusing more on the stock market. And, the concern that I have is that, we've been straining relationships with other nations who, you learn on day one of Finance 101, you learn that, that the U.S. Treasuries are the risk-free rate. There's really no risk of default. Well, Moody's in the last week or so, they have downgraded our credit rating. That was our last AAA credit rating, indicating that there is more concern in our stability and our risk-free levels than there has been previously. So what that represents is, a lot of governments who have been investing in our treasuries are beginning to have concerns and doubts on whether we are going to continue with our promises related to these treasuries. Remember, a treasury bill or bond is basically a short to long-term debt issued by our government on the promise that we are going to repay that debt. Now, with the Trump administration, a lot of people are concerned. Are we going to actually fulfill our promises, or are we going to break promises? And, that's been breaking the bond market. And I have a feeling that's going to become a larger concern. I think that's also going to converge with, with all the other market concerns. And I think we're talking about a much larger, issue going forward. I think from a national perspective, I am concerned about the health of our, overall economy and moving forward. That said, not everything is as bleak as I might make it out to be. There's always windows of opportunity. There's the saying, I think it was to one of the members of the Rothschild family more than 100, I think maybe even going back as far as 200 years ago. The Rothschilds being a famous banking dynasty family. And they said, when there's blood in the streets, buy. And ultimately that's since been converted to buy real estate. And, even if I go back into, New York's history and, I go back to the family that founded, let's just, narrow it down, the family that founded the Waldorf Astoria, which was, a merger between two families. But the Astors, the Astoria family, of the Waldorf Astoria, but the Astor family, basically the patriarch of the family, when he passed, right before he passed, on his deathbed, he said, my one regret was not buying more Manhattan real estate. So, that said, I'm like, I can find, some reasons for optimism. Now, I do want to talk more, we're transitioning more into the Manhattan side of this conversation. And I wanted to, basically convey that, like, in the big picture, I actually see a much rosier aspect here than I see in the national market. Now, first off, it's important to note that if we have, let's say, a light recession, now we're not immune to everything that's going on in the economy, but in Manhattan, if there is a light recession, we are more likely to actually have a positive price movement in Manhattan for real estate than the rest of the country. Where the rest of the country might be declining, we would more likely be accelerating and prices rising. And that is, we are just built very differently, and the mechanics of which are, number one, we have a reversal on, the way that, buyers versus renters. And, the ownership is basically the exact opposite of the rest of the nation. In most of the nation, and I'm just going to round off and give some very simple figures, but say in the rest of the nation, roughly around 2/3 of the people own and roughly 1/3 rent. Here in Manhattan, it's the flip way around, roughly around 2/3 rent and 1/3 own. And of the ownership, it's broken down even stronger, where approximately 70% of that market is co-ops, and they are far, far stricter than what you're going to find with a lending institution. So the banks are, might have strengthened their underwriting standards, and at the same time, that still doesn't matter to most Manhattan co-ops because they're going to be way stricter than the banks are going to be. And there's a lot of reasons underpinning that, and that could be a conversation for a whole different talk in the financial requirements to buy a co-op. But they represent 70% of our inventory here, and and being that kind of extreme scrutiny that co-ops give, and they're 70% of the market, kind of helps determine the strength of our market. And what we've seen is this lost decade in Manhattan, and I think we can now call it a policy-driven reset, and that was as a result of a lot of additional regulation. Some additional taxes and things that have changed on the tax rate front, and that actually ties into Trump's big, beautiful bill, and at least in part, and in terms of like interest rates as well, and how that's been impacted. Now, it's worth mentioning also how we are different from most other markets. Today, somewhere roughly, I don't have the exact numbers, but roughly speaking, about 60% of our buyers here in Manhattan are all cash buyers. Now, every time a buyer comes to me and said, well, if I'm all cash, does that make a difference? And saying, well, it definitely gives you priority over somebody that is financing, but it's not necessarily, indicating a discount and a further discount off of the, the price that we negotiate. So, since so many buyers are doing that, in that strength, we don't necessarily have that discount built in for all cash buyers, but it's important to note that the vast majority of buyers today are going to be, all cash, and those that are financing, many of them are putting down significant down payments, in excess of 30%. So, I think if you wind up seeing like the numbers, I want to say it's somewhere around like at least 35% down payments is what it works out to be on average for those that are financing. So, we are fundamentally different in the rest of the nation. Now, in much of the nation, we are much better and stronger overall than we were pre, the financial crisis, where people were using interest only, zero amortization mortgages, or FHA, here in Manhattan, I only know of right now one building that is FHA approved, and they are, that building only came out as a condo conversion recently, and they are selling quickly as a result. So there's, hardly any FHA opportunities. So in most cases, condos are going to require a minimum of 10% down, and co-ops typically are going to be minimum 20% down. But the reality is a lot of them could be much more than that. And as far as banks are concerned, a lot of them want to see, 20% down anyway. So at least for the Manhattan market. So that helps explain a lot of the stability that we see here, even though prices have gone down a lot because of regulation and taxes and the combination with interest rates and whatnot. But overall, we have a very stable market. Today, and looking forward, I've already mentioned the number of cash buyers. That doesn't seem to be changing much anytime soon. I think even before we've had these current interest rate hikes a few years ago, I think even back then, the number of all cash buyers was probably still roughly around 50% or half of buyers. So I don't think that really changes dramatically, with the interest rates. Obviously, as they've gone up, buyers have found other ways to go all cash, and including using their securities accounts, as leverage, and doing a cash out, of them, and basically borrowing against their own money and using that as leverage. And that is, a pretty common strategy here. So again, it marks a lot of what we see here in Manhattan and why it's so very different than, so many of the other markets. So what we're seeing now is really we're coming down from a lot of the very heavy regulations. Things kind of started in 2016 when we had this new money laundering law. And that was when I was first making my transition from capital markets into residential real estate sales. And it was one of the important questions that I was asking every broker. And, the director that I've been working under for the last 9 years, he answered this question correctly. And the brokerage community that we basically wound up merging with, I had interviewed with them and they impressed me as well. They were my second choice, but and ultimately now I wound up working with them as a result. But Elgren's been absolutely great, but I immediately clicked with my director, so that was my reason for choosing them. But they both answered my question correctly. Is when I asked them back in 2016, how do you think this new $3 million purchases going through money laundering requirements and checks is going to impact the Manhattan market? And they both said, yeah, we do think this is going to have, some real impact. And any brokers that I interviewed before that, were poo-pooing it, and I said, no, they don't seem to understand the larger economic consequences of what's happening here. And since 2016, we saw prices have moved up and bounced up and down and whatnot. But overall, we're pretty stable, from that decision forward of, that regulation. And we've added a lot of regulations. We've added a lot of taxes. I'm not saying that the regulations are necessarily all bad. Some of them I actually are at least somewhat in favor of, depending on the points that we're talking about. I do think that the Albany and city, and the city council have gone overboard on some of them. And I think we're going to feel some additional pain, on that. But that's more the multifamily investing front rather than individual condos and co-op market. So I think that has got to go through some transition on the multifamily market. Since that's much more of a commercial market, that's conversation for a different message, and more for the commercial brokerage side rather than the residential side. But it's important to be aware of what's going on in all these different markets and how they wind up impacting things as a whole throughout the city. We've had, more of a return. What's happened in the last few years is we went up a bit first we declined from the scare of COVID, and that didn't last long. That only lasted a couple months, 3 months max. But the price dips that we saw, the extreme, only lasted maybe about a month or so. But the slight downward trend that we saw, that lasted, no more than 3 months total. And then we started going up especially as, as there was this artificial demand created as a result of interest rate cuts. And, and then we started seeing things fly high. And now that we've seen the last 3+ years now, interest rates have gone up significantly. We've seen things come back down in terms of pricing. Overall, when you look at the bigger picture, again, prices overall are stable. And I think that is the tale to tell over here. And I think when we talk about stability is now a lot of, despite what's going on in the larger economy, some of the things that we need to point to here is that you're looking at things like, I think it's the 5 Ds, if I remember correctly, diamonds, diapers, divorce, disaster, and of course, death. All those things wind up impacting our markets routinely. And I think we're, those that could hold off under the 5 Ds, if it was possible, had been. And we're getting to a point where the typical owner in Manhattan, I'm not typical. I've owned my place for 19 years and counting, 19 and a half years, if closer to. Anyway, that is not typical. In typical Manhattan fashion, owners hold on to their place, anywhere from 3 to 7 years for the most part. And as a result, of interest rates being high for the last 3+ years now, and, who knows when people might have locked at a lower rate, could have been easily 5 years ago at this point. And as a result, people losing those low interest rates when they had ARMs because the ARMs are resetting. Now they're looking at much higher rates and they're wondering, I'm like, should I really hold on to this place if I'm going to be paying, someone in the same neighborhood as if I was to buy fresh and get a fresh mortgage? I don't have the advantage of that sub 4% mortgage any longer, or maybe not for much longer. And I think that goes back to the larger equation of the Manhattan market, is that we are returning because a lot of people are looking at those ARMs that are expiring, and now you're seeing the rate resets. You're seeing a lot of people that kind of pushed off life events. What happens if you bought a 1-bedroom plus home office? You've now had a baby, and it's getting harder and harder to keep that baby in that home office space. You probably need to upgrade to a true 2-bedroom or maybe even larger at this point. You put it off as long as you could, but that only works for so long. It winds up becoming a stressor point. So all these types of things that we're finally seeing come and back into the marketplace. We're finally seeing inventory increase a bit, which it's been at these incredible lows. And for me, that's been one of the challenges in working with a lot of buyers right now, is that for a lot of buyers, I had this conversation about, what to expect in the search. And then it comes up, I've got barely anything to show them. And this has been going on for the last few years. And I'm like, if they're not have their timing perfect, they don't have their offer perfect, the reality is they miss out and they might not have another chance to get something similar 6 months, a year, 2 years down the road, because what we've been seeing is the inventory has been so scarce. Now, for the last 2-3 months or so, I'm finally starting to see an increase in inventory. Not a huge increase, but better inventory. The types of things that my clients have been asking me for. So, for instance, I've got that client that has got a certain price point on the northern section of the Upper West Side. They have very strict parameters in where they're looking to live. Fine, no problem. I've always been able to work around that. And they want something that's pre-war with a lot of the original old character, and their budget is this much, and they're looking for a 1-bedroom, but enough space that they could have a dining room table, that they don't have to keep moving because they like to host a lot. For a lot of dinners. So, they don't want to have to pack up a table and have it, put into the closet half the time. And, so they want a true larger space. And quite frankly, I'm like, in the past, I could have said, what, that price point's realistic. But the last couple of years, I'm like, there might be one every 2 years that come up. And, if you don't have your act together when the timing is right, you missed out on it. So that's been the challenge that I've had in working with a lot of clients, is that the inventory just hasn't been there. So now what we're starting to see, and it's just very early in the game, we were only seeing it for the last couple months, is that we're starting to see new and better inventory rather than the same inventory relisted with another broker and maybe a slight price downward movement. And that's really been the tale of what's been happening in recent years. I keep seeing the same inventory relisted over and over again. And they're not necessarily the best options, because the best options have always gone quickly. So that kind of gives you a sense of what's been going on, in our market. Now, this is all like the general Manhattan market. So since I also specialize in, we'll spend a few more minutes talking about the northern Manhattan market, for the clients that are a very large portion of, the buyers and sellers that I work with. The larger tale here is that, Harlem and, neighborhoods north of the Upper East and Upper West sides, have gotten hit harder. A lot of those buyers have gone to Brooklyn, I think in part not only because of the style of the inventory, but the quantity of inventory available for there. Now, Brooklyn is, been slowing down a little bit, but not necessarily, to the same degree of what we've seen in Harlem, in Morningside Heights, in Hamilton Heights, Washington Heights, Inwood. In Manhattan Valley as well. So these neighborhoods that they've, not only has the inventory been slim for the most part, but it hasn't been the cherry of the inventory. The rare times that we do see the cherry homes, we've been seeing them at lower prices and hang on the market longer. I've had buyers that are telling me, they're like, yeah, I'm really interested in this. And I'm like, but, I'm not sure that right now is the right time for us. And then there's like, well, I'm like, this is such a great opportunity. Why hasn't it moved? I'm just like, that has been the tale of what we've been, addressing, is even some of the cherry apartments, there's no necessarily rhyme or reason why they are necessarily sitting when they do. But for the most part, most of the cherry apartments do tend to really move. The best ones always tend to. But, even in this market, there's been enough uncertainty where not everyone knows. So let's break down some of the impacts of what we've seen too, and the impacts of a lot of the regulation, what we've seen across the city, and it applies to Upper Manhattan too, just not as harsh, but certainly it still hits, throughout the city, is with all this added regulation and compliance that are needed from buildings now, that's forced, especially on the insurance front, that has forced prices on the monthlies to go up. Now, property taxes have gone up a little bit, and, but in addition to the property taxes, it's also the common charge or the monthly maintenance if we're talking co-op. But these monthly charges have gone up significantly, in the last few years. To say conservatively, you're probably looking at 20 to 30% increases in most buildings, in most situations. Now, I've gotten lucky, and this isn't going to apply for my building or for many other buildings in Upper Manhattan for much longer anyway. And throughout most of the rest of the city, it's already expired anyway. But I have a 421A tax abatement, which means that, and this is kind of shocking to a lot of people, but for the last 19 plus years that I've lived in this apartment, my property taxes have been, give or take a few pennies, but somewhere in the rough neighborhood of $3.50 a month for the last 19 plus years. Let me repeat that, $3.50 a month. A cup of Starbucks or a Frappuccino or whatever, concoction you can come up at Starbucks costs more than my property taxes. Now, I'm nearing the end of it. I have just a little over another year for that full abatement. The following year, it's going to increase, probably tenfold, which is still, maybe 15-fold or something like that, which is still incredibly cheap, but it'll start each year rising to the full tax amount. So these opportunities still exist in Harlem. Some of them are going to begin to roll off or have already begun to roll off toward their full tax amount. So this is why I say, I'm like, buy now, get that price advantage and start building that equity now, especially when we're seeing prices. And I'm prepared to call it, is I believe we are at a multi-year low in terms of prices. And I think that is really kind of a key in all of this, is that, I really don't think, even if we wind up having, impacts in September and October due to a lot of Trump's actions and, some shakiness in the economy, I think we are multi-year lows, and we're back to like 2015 prices, 2016 prices roughly. So it's been really like a lost decade, and as much as the impacts can be felt by some sellers, especially those that have bought in more recent years. Those that have bought beforehand and have been long-term holders, have been able to benefit from the long-term price appreciation anyway. So for me, buying 19 years ago, I'm still seeing massive price appreciation, even though we haven't seen any effectively since 2015. So, there's that, but there's also the impacts of things like the failure of First Republic Bank, which, underwrit in a lot of these buildings that are not easy to underwrite in. Now, I don't want to get too heavily into the differences of, different types of lending situations, but briefly, really quick, like there's agency lending, and that's known as like Fannie Mae, Freddie Mac. These are semi-quasi government agencies versus portfolio lending. Now, in agency lending, these get rolled up into mortgage-backed securities, and you see this go back into a larger trading market. Whereas in portfolio lending, it's individual bank decisions, and they hold on to that mortgage even when it would have been sold out to a mortgage-backed portfolio security if it was agency lending. So in these kind of situations, these are the things that are kind of impacting some of these scenarios. So since the impact and what wound up happening with First Republic, since the impact of all that has gone down, the reality is that First Republic had a massive impact because they decided to underwrite in everything, and they were giving below market rates to do it in Upper Manhattan. So that has really been an impact. Now we're first starting to see some players that wind up are replacing the impact of First Republic for the first time in a few years now, but it's still not the complete solution over here that we need for underwriting in properties. So that is part to do with some of the discount in terms of, Harlem properties. I do think that we are ultimately going to fix that issue, and banks will start underwriting more readily going forward, I think as time passes. A lot of this has to do with a lot of the regulation relating to local law 11 and the health of the building. But that's conversation for another video. Townhouses, I think is the last thing I really want to talk about in Upper Manhattan. I've done the analysis, I've done the review of all this, and what we're seeing is and I've done a deep dive in the last 5 years, not including the last few months. I need to re-include that information. But for the 5 years prior to the last few months, what we were seeing in Hamilton Heights was that they were reflecting something like 30% of the listings for townhouses, and the rest of Manhattan, it's 1 to 2%. So that's point number one with the townhouse market. So that's represented a good portion of the listings that we've seen for sale in these markets. Number two, the other aspect, to take into account is we were seeing the same inventory not sell over and over and getting relisted and relisted and relisted each time by a different agent, each time with a different price, and it goes up and down. And, ultimately what we've been seeing in the trend of the last 5 years is, that it typically has been taking, and we're now starting to see this accelerate a bit in the latest data. But, over the last 5 years, prior to the last few months, what we were seeing was typical townhouse stayed on the market, plus or minus a little bit, but for an entire year before it went up selling. Not only that, in Hamilton Heights, and I crunched the data, and this is one of the few people, I'm probably one of the few people that have done this work. But when you crunch that data and see what you end up ultimately seeing is, in order for the townhouse to sell, 76% of the townhouses that had sold in Hamilton Heights in the last 5 years had two factors in common. Number one, they were at least 17 feet wide. Now that's important because most of these are row houses. They're semi-attached housing, to each other. And, even though they might be brick against brick, it's they're your own house. But that's why we're calling them townhouses, even if they come in the form of brownstone, or limestone or whatever the category might be of the finishes. But the reality is that because these tend to be along the blocks, they tend to only have window openings that are facing either north or south. And the width winds up determining really how many windows or how wide the windows are going to be. This is the reason why I say it's important in townhouses to judge that, or make the determination on the width. Now, in much of prime Manhattan, often you'll hear it's got to be at least 20 feet wide. We don't see a whole lot of 20 feet wide townhouses up here in northern Manhattan, but we do tend to see a lot that are at least 17 feet wide. Those that were less than 17 feet wide tend to lag on the market. But that's not the only factor that was determined in this data in the last 5 years. The other factor was that what we tended to see was that in the data was that the property taxes had to be under $1,000 a month. So both 17 feet wide at a minimum and property taxes of under $1,000 a month. These were the overriding factors, and this represented 76% of the closed sales in the last 5 years, had to have both 17 feet wide minimum and the under $1,000 a month property taxes. So that was real determination. And, being that townhouses are typically been on the market for a year or so, give or take a little bit, these are the important underwriting factors. Now, what we are seeing is, again, back to that normalization story. And that is really the true tale of what's happening now. We're finally seeing new inventory, both on the condos and the co-ops and the townhouses, and they're better inventory, things that are fresh, that are new, that we haven't seen before. And you know what? They're the ones that are selling, and they're selling much, much faster. So, I think this all tells to a story is that, and is consistent with what I've been seeing, back to the 5Ds and normalcy, we are seeing a return to normal. It's not equal in its return, and you're seeing that all across Manhattan. It's not an equal return, but we are seeing the first signs, I guess the grassroots, signs that we are returning to normal. So I think I've talked long enough and, given everyone a nice, healthy overview of what's happening in the larger economy and how that winds up impacting Manhattan, and more specifically drilling down further on how that impacts Upper Manhattan. But I want to thank you for making it through this very long video. And for anyone that has, thank you very much for listening. And hopefully I've made this time worthwhile for you. And, I think if I get some positive feedback, I'll do this more often. But thank you for your time, and thank you for listening. Have a great day. Cheers.